Hello, dear viewers! With Bitcoin hitting record prices, we want to explore the future of cryptocurrency and see which governments are ready to legalize it. The investment bank Standard Chartered has published an analytical forecast suggesting that by the end of 2028, the total volume of stablecoins in circulation could reach approximately $2 trillion, compared to today's figure of about $250 billion. This is primarily linked to the potential adoption of government regulation over cryptocurrencies, particularly the Geno-Use Act. Stablecoins, as a class of digital assets, emerged on the market mainly to meet the internal needs of traders for a stable and fast medium of exchange. They were pegged to hard currencies, predominantly the US dollar, and became a kind of substitute for bank transfers in the crypto sphere. Over time, stablecoins have begun to play an increasingly significant role. It has reached the point where about 80% of all cryptocurrency transactions involve this type of asset. Stablecoins are gradually moving beyond being just a trading tool. They are starting to be used as a store of value in countries with unstable currencies, as a tool for international settlements, and as a foundation for digital payment systems. And, by the way, they also work for circumventing sanctions, so something needs to be done about that. The stablecoin market is dominated by two centralized tokens, USDT and USD Coin, USDC, which together account for over 90% of the total supply. The private companies that issue stablecoins operate on a simple principle. For every dollar they receive, they issue a corresponding token and guarantee that this token is backed by assets held in reserve. These reserves usually consist of liquid, short-term instruments, such as treasury bills or repurchase agreements, repos. Fundamentally, the structure is similar to how money market funds operate, investing in short-term debt instruments. That's the essence of it. This mechanism allows the tokens to maintain a stable exchange rate, as the assets can be quickly sold during large-scale redemptions, supporting the token's value at a 1-to-1 ratio. These assets generate temporary profits from interest income, though this income depends on short maturity terms and yield rates, which makes issuing stablecoins economically viable. However, if investors were to start en masse exchanging their tokens for fiat currency all at once, the company could be forced to rapidly sell its reserves, which would exert significant pressure on the debt market. In a recent analytical report, the Bank for International Settlements concluded that stablecoin issuers purchased approximately $40 billion worth of U.S. Treasury bonds over the past year. For comparison, this is nearly the same level of purchasing as large government funds and exceeds the acquisition volumes of most foreign investors in this segment. As a result, their behavior can significantly impact monetary policy and financial stability. The aforementioned private company, Tether, has become extremely profitable, reporting a net profit of $13 billion in 2024. And this is with an average staff of only about 100 people. It has gotten to the point where the company is nearly on par with major investment firms like Goldman Sachs. This raises a logical question. How can a company that issues stable tokens with a fixed exchange rate earn billions? It's actually quite simple. Behind every token is a real portfolio of assets, primarily government bonds, deposits, and cash reserves. In other words, it operates on the same principle as money market funds or short-term investment instruments, just wrapped in a crypto-asset package. Now, riding the wave of Tether's success, similar offerings are emerging. One of them is the crypto company World Liberty Financial, actively supported by President Donald Trump and his sons. Trump is getting involved in everything related to cryptocurrencies right now. But we'll see. It's all very politically tied. This means it could become quite unstable over time if, for example, his ratings drop. The company will face corresponding problems. In March 2025, this company introduced its stablecoin, $1, which is backed by short-term U.S. government bonds and similar liquid assets. World Liberty Financial is 60% owned by the Trump family, and 75% of the net income from token sales goes into the family budget, so to speak. In just a few weeks, the stablecoin's market capitalization exceeded $2 billion. But the reason for its success also became its problem, namely, the persona of Trump, which quickly sent its charts into the red. Tether regularly confirms that every token is backed, but it does not conduct a full, independent audit. Instead, it publishes attestation reports. Notably, researchers at Consumer Research have pointed out that the company avoids undergoing a formal independent audit acceptable to the Big Four accounting firms, and they have expressed doubts about how much cash is actually held in reserve. There's already a precedent for this. In 2021, Tether agreed to pay a $41 million fine to the U.S. Commodity Futures Trading Commission, CFTC, for making false claims that USDT was fully backed by US dollars in its accounts. Simultaneously, in a settlement with the state of New York in February 2021, Attorney General Letitia James stated that Tether and Bitfinex had knowingly concealed losses of about $850 million that should have been covered by USDT reserves, and had repeatedly lied to their investors. Despite all this, the volume of stablecoin transactions, excluding automated trading, reached $752 billion last month, an 84% increase from $409 billion in the same period last year. At the same time, the average number of active wallets regularly sending and receiving payments grew to 46 million, up from 27 million in 2024. Inspired by this success, our public officials have also proposed adding cryptocurrency to the national reserves. However, in countries with developed financial and banking systems, stablecoins are less prevalent. This is because the population has access to systems with low fees, high transaction speeds, and convenient mobile wallets like Apple Pay and PayPal, reducing the need for tokens as a means of payment. It's also worth noting that these traditional systems are transparent and operate within a legal framework. They don't need to hide anything, they file tax declarations, and everything is above board. There's no need to operate in a gray area. This is another reason why development is slower in Europe. It's happening, but to a lesser extent. Stablecoins tend to thrive where traditional currencies are unstable or banking and fiscal systems are imperfect. Some even consider a complete shift to a fully digital circulation as one of the key threats. Mike Sholov, CEO of Fireblocks, notes that the primary application today is in cross-border payments, where the traditional banking system is broken due to long settlement times. According to him, using stablecoins can reduce settlement times from 3 days to 10 seconds. As proof, about half of all transactions on the company's networks since 2024 were conducted with stablecoins. Despite their potential for legitimate use, stablecoins, especially USDT, remain a primary tool for illicit schemes. According to a UN report from January 15, 2024, on the activities of criminal syndicates in East and Southeast Asia, USDT has become the most used cryptocurrency for money laundering through illegal casinos, online romance scams, and other forms of cybercrime. In 2024, 63% of illicit crypto transactions involved stablecoins, according to Analysts. The total value of all cryptocurrency-related fraud is approximately $51 billion, which is a substantial amount. Theoretically, all blockchain transactions are publicly available and can be traced. For instance, Tether reports that it regularly freezes accounts linked to suspicious activity at the request of authorities and OFAC. In September 2024, the company blocked over 1,800 wallets. The same Michael Sholov explains that both banks and stablecoin operators use KYC procedures and transaction monitoring through third-party providers that custody the crypto assets. This allows for faster verification of clients and transactions compared to traditional banking systems, which have historically been plagued by various problems, attacks, and scandals. But it's not all perfect here either. A direct quote from Tomasina Carmona of Brookings Metro. Federal law enforcement agencies, which once led the fight against fraud and abuse related to cryptocurrency, are now being restructured or defunded. Another issue is that almost all companies store assets in omnibus accounts rather than separate accounts for each user. While this is technically simpler and creates fewer operational headaches, it complicates the tracking of funds. In the event of technical failures or cybercrime, it would be difficult to assign responsibility, and there is no guarantee that depositors would get their funds back. Today, much still relies on trust, and there is a clear need for more audits and more control. Not so much regulation that it stifles everything, but the system must become more transparent. The U.S. Department of the Treasury has stated that $6.6 trillion currently held in deposits at commercial banks could be withdrawn by customers in favor of stablecoins. If this trend gains momentum, it could significantly destabilize the traditional banking model, while also demonstrating the high demand for this type of cryptocurrency. Again, if cryptocurrencies win the competition against traditional banks, so be it. There's no issue there. But for banks to lobby to kill this process just to preserve their business is also wrong. What is more efficient should survive and thrive, and the people will show what that is. At the same time, the negative aspects of stablecoins, like the lack of transparency and their active use by countries like Russia to evade sanctions, as well as by their mafias, these issues must be addressed, friends. There's no getting around it. Therefore, this trend, if it accelerates, could significantly destabilize the banking system. A mass migration of both retail and corporate players to digital currencies could force banks to raise interest rates to keep their deposits competitive. As they say, there are pros and cons, but this could also make loans more expensive. Everything has its consequences. Let's get to the most important part: potential regulation. The Geno-Use Act, a bill introduced in the U.S. Senate in 2025, aims to create a clear legal framework for issuers of stablecoins pegged to traditional money. Most importantly, only 3 types of organizations could become stablecoin issuers: banks, non-bank issuers licensed by the Office of the Comptroller of the Currency, and entities licensed in one of the states that meet basic federal requirements. Stablecoins must be fully backed one-to-one by liquid assets. Reserves must include cash, deposits at the U.S. Federal Reserve, and Treasury bills with a maturity of no more than 93 days. The law explicitly prohibits using reserves for any other financial operations, such as collateral for loans, and requires regular reporting, including monthly disclosure of reserve composition confirmed by an independent auditor. Companies with assets over $50 billion would be required to undergo an annual financial audit. A ban on paying interest is also imposed to avoid competition with banks. However, there are some loopholes. The bill provides neither for deposit insurance nor a special mechanism to protect issuer assets in case of bankruptcy. If an issuer fails, users' funds could be locked up in bankruptcy proceedings for a very long time, with no guarantee that people will get back 100 cents on the dollar. According to law professor Hillary Allen, the asset formation mechanism would also mean that every dollar moved from a bank deposit to a stablecoin creates about 90 cents of additional demand for government bonds. To meet this demand, the government might be forced to issue new short-term bonds, which could alter the overall balance and affect interest rates. Overall, stablecoins have the potential to become a new medium of exchange, but they must undergo a lengthy transformation process. Mass adoption can only become a reality with clear international rules, growing trust, and integration with financial markets and the broader system. For now, traditional money is not under threat, nor is the traditional system itself, but everything has its time. So stay informed. I hope this video has given you a better understanding of what this is all about. Even if you don't have a crypto wallet or use this tool yet, you should now have a sense of where things are headed. Sooner or later, most economically active people will use this. The question is about the quality and transparency of the institutions, the organizations and financial entities that will issue these currencies. How well will they be backed? How transparent will their use be? And so on. I think that's clear. All the best to you all. Goodbye.